Welcome back, dear students and scholars. We have already seen what receivables are and how ASC 310-10 handles recognition and measurement. Now we move into ASC 310-20, where the real economics of lending starts to show up. A loan is not only about principal and stated interest. The lender may receive non-refundable fees, pay direct origination costs, acquire loans at premiums or discounts, and charge commitment fees. Under US GAAP, these items do not simply sit outside the loan. They reshape the carrying amount and the effective yield. Here is the core idea. Cash received today can change yield tomorrow. Suppose a loan says 8% on the contract, but the lender also collects an origination fee at closing. The lender's actual net investment is lower than the face amount, so the real return is higher than 8%. ASC 310-20 forces us to look past the coupon rate and ask the better economic question. Given everything the lender paid and received, what is the real rate of return on this loan? The learning path is a clean 6-step process. First, identify the fee or cost. Second, check whether ASC 310-20 applies. Third, defer the eligible net amount by offsetting qualifying fees and qualifying direct costs. Fourth, adjust the loan's carrying amount. Fifth, recognize that deferred amount over the loan life using the interest method. Sixth, update the effective yield if assumptions such as prepayment or extension change. Once you understand this sequence, most fee and cost questions become much less scary. ASC 310-20 focuses on non-refundable lending economics. For this video, we are mainly looking from the lender's side. The major items are non-refundable loan fees, direct loan origination costs, commitment fees, loan purchase premiums, loan purchase discounts, and certain lending activities. The standard is not trying to create a separate income bucket for every fee. Instead, it asks whether the fee or cost is really part of the loan's yield. If it is, the amount belongs in the carrying amount and interest income pattern. Scope depends heavily on how the instrument is measured. Loans held for investment are the classic case because they are carried at amortized cost. Loans held for sale can also be affected, although their later measurement uses lower of cost or fair value logic. Available for sale debt securities bring in other comprehensive income for unrealized gains and losses, so be careful with presentation. But trading securities, fair value option instruments, and derivative commitments usually sit outside this deferral model because fair value changes already flow through earnings or derivative accounting applies. The core deferral rule is simple but powerful. Start with loan origination fees received, subtract direct origination costs paid, and arrive at a net deferred fee or net deferred cost. That net amount is not recognized as income at closing. It is recorded as a direct adjustment to the loan's carrying amount and then recognized over the loan life as an adjustment to interest income. This is an effective yield model, not a casual straight line shortcut. The income statement should reflect the economics of the loan over time. Direct origination costs must pass a strict filter. The costs must relate to a specific loan, it must be incremental to the origination process, and the transaction must actually close. That is why direct borrower evaluation costs, security arrangements, collateral related costs, and direct commissions on completed deals may qualify. But the word direct really matters. A cost that helps the lending department generally is not enough. ASC 310-20 is focused on costs that would not have been incurred without that specific completed loan. Many lending costs are expensed immediately, even if they feel connected to lending. Advertising, borrower solicitation, servicing existing loans, credit policy administration, loan software used across the portfolio, general supervision, and routine service fees normally fail the specific loan and incrementality tests. These are period costs, not deferred loan costs. A useful exam shortcut is this. If the cost cannot be traced directly to one completed loan transaction, do not try too hard to defer it. The default answer is usually expense as incurred. The direction of yield depends on whether we have a net fee or a net cost. A net deferred fee reduces the initial carrying amount below face value. The same contractual cash flows are then earned on a lower net investment, so the effective yield goes up. A net deferred cost increases the initial carrying amount above face value. The same contractual cash flows are now earned on a higher investment, so the effective yield goes down. The carrying amount is the bridge between fees, costs, and yield. Now let us set up the example. On January 1st, 2026, a lender advances a $1 million 5-year loan. The stated interest rate is 8% with annual interest payments, and the principal is repaid as a bullet payment at maturity. The lender receives a $20,000 origination fee from the borrower and pays $6,000 of direct origination costs. We are not recognizing the fee immediately. We first net the fee and cost, adjust the carrying amount, and then solve for the effective yield. The first calculation is the initial carrying amount. The lender receives an origination fee of $20,000 and pays direct origination costs of $6,000. Net them together and we get a $14,000 net deferred fee. Because it is a net fee, it reduces the loan asset. So the $1 million principal amount becomes an initial carrying amount of $986,000. That $14,000 is not day one income. It will be recognized into interest income over the loan life. With the carrying amount set at $986,000, the lender solves for the rate that equates all expected contractual cash inflows to that amount. The cash flows are $80,000 of interest each year for 5 years, plus $1 million of principal at maturity. The effective yield is about 8.35%, slightly higher than the 8% stated rate. That difference is the economic effect of collecting a net fee at closing. Small percentage, serious accounting impact. In year one, the lender applies the 8.35% effective yield to the beginning carrying amount of $986,000. That gives interest income of about $82,371. Cash interest received is only $80,000 based on the 8% stated coupon. The difference, $2,371, increases the carrying amount. The ending carrying amount becomes $988,371. Over the loan life, this accretion brings the carrying amount back to $1 million. Commitment fees depend entirely on what happens to the commitment. If the borrower draws on the loan, the commitment fee is deferred and treated like an origination fee, then recognized over the loan life through yield. If the commitment expires unexercised, the fee is recognized as income at expiration because the lender has completed the stand-ready service. If exercise is remote from inception, the fee is generally recognized as service fee income over the commitment period. The key is not the fee name, the key is the outcome. Take the line of credit example. The facility amount is $2 million and the commitment fee rate is 0.10%. The total fee is $2,000. Because the borrower's draw is assessed as remote, the fee is not deferred into a loan yield schedule at inception. It is recognized as service fee income over the commitment period, normally on a straight line basis. If facts later change and the borrower actually draws, the lender reassesses the accounting and any unrecognized fee can become part of the origination fee pool. Purchase loans use the same economic logic. If a lender buys a loan above face value, that premium increases the carrying amount and reduces the effective yield. If a lender buys a loan below face value, that discount reduces the carrying amount and increases the effective yield. Direct acquisition costs also affect the initial carrying amount, but keep the boundary clean. ASC 310-20 handles yield. Credit loss assessment on purchase loans belongs under ASC 326, including the current expected credit loss model. Loan syndication fees have their own rule. A lead lender that arranges a syndication generally recognizes the syndication fee when the syndication is complete because the arranging service has been performed. But there is an important exception. If the syndicator keeps a portion of the loan, and its yield on the retained portion is lower than the average yield earned by the participant lenders, enough of the syndication fee must be deferred to correct the retained yield. The accounting prevents the lead lender from front-loading income while keeping an under-yielding loan. Let us finish with the memory map. Identify the fee or cost, separate deferrable items from period costs, offset origination fees against qualifying direct costs, adjust the carrying amount, and recognize the deferred amount through effective yield. That is the heart of ASC 310-20. Next, we move to refinancing, modification context, factoring, and derecognition boundaries, including why the old creditor troubled debt restructuring model is not the current framework. If this lesson helped you, please like, share, subscribe, support the channel, and share it with your colleagues.